Are you interested in investing in a company that makes money, lots of money? Do you also want that company to spend money, all of its money?
And it's gone.
Well, you're in luck because I have the industry for you. For a low multiple of infinity, you too can own a share of a SaaS company that's hemorrhaging cash. All jokes aside, I love SaaS, but like most industries, it's got its downside. The SaaS industry has been on a rocket ship over the past few years. Even Warren Buffett's Berkshire Hathaway invested in a SaaS business a few years ago, although a lot of those profits have since disappeared faster than Nissan's CEO. SaaS done right is a great business model. Look at ServiceNow and Workday. They're both hiring, while it seems the rest of big tech is firing people.
We're going to add several thousand new heads this year.
SaaS brings predictable revenue and big gross margins, but finding profitability can be hard. Just a quick disclaimer, I currently don't own any of the stocks mentioned in this video, and this is not investment advice. You should absolutely do your own research. And if so far you like this video, please go ahead and subscribe because I'm going to be doing videos every Monday through Friday, ideally. So be sure to subscribe so you don't miss any of those. The SaaS we know today started in 1999 when Salesforce launched their CRM product. Before then, software was distributed on floppy disks and CD-ROMs. SaaS utilizes the cloud so people can access it anywhere they want, whether they're on laptops or on their phones. The alternative to this is on-premise software, where it gets installed on computers on companies' premises. There are still some SaaS companies that do on-premise software in cybersecurity and other industries, but for the most part, it's in the cloud. There are three main ways modern SaaS companies make money: subscriptions, services, and now payments, such as Shopify. Customers can subscribe to a SaaS service either self-serve online or by talking with the sales team. A lot of the big SaaS companies today, such as HubSpot and Salesforce, have a combo of both, where you can sign up for small business accounts, or if you need a large one, a sales team will help you out. The two main ways SaaS products are priced is seat and usage-based. For seat-based, you pay per account that's on the platform. For usage-based, you pay more as you use more or you use less, such as an email provider. The more emails you have in there, the higher the plan you'll have to be on. There are a few metrics that investors need to know if they're going to invest in SaaS. You'll see these on all the SaaS companies' annual reports and presentations. First one is either ARR or MRR. That just stands for annual recurring revenue or monthly recurring revenue. This is the annual revenue contracted over that certain period. For some companies, this might not be too sticky. Maybe somebody signs up for a month or two and then cancels it. For other companies such as Salesforce, they could be very big contracts that last over years. The second important metric is churn. Churn measures the amount of either customers or revenue that leave during a certain period, whether it's monthly, quarterly, or annual. The third important metric is net revenue retention. Net revenue retention is the total of retained, contracted, and expanded revenue over a set period, typically a month, maybe a quarter, or a year. It takes into account all of the revenue that left. So ideally, this is over 100%. That shows that the business is still growing its revenue even while some people leave. It's also important to note that you'll see a lot of these SaaS companies group their customers into cohorts for how much money they spend per quarter or year with them. And so you want to pay attention to those cohorts to make sure that they're growing. Oftentimes, these cohorts will be the customers that pay the company the most amount of money, such as $100,000 or $1 million a year. So as investors, we want to make sure that those are growing. One of the biggest issues I think with SaaS is the competition. Very few SaaS companies actually have moats. Take a look at Asana and Monday.com. Both competitors in the work operating system space, similar to the private company Notion. Both are fairly big businesses, but they have to spend a fortune on marketing and R&D to stay ahead, and neither have turned a profit yet. These are called horizontal products, where they can be used across a wide range of verticals. Another horizontal product is Slack, and Slack couldn't make it on its own and had to be purchased in order to survive. I think the more niche or vertical the product, the better. Take a look at Bentley Systems. Bentley Systems is an infrastructure engineering software company, and it's profitable and it's paying a dividend. Bentley Systems has a much better moat than say Monday.com or Asana. Much less likely that there's going to be other infrastructure systems software companies popping up, but another work operating system software such as Asana or Monday.com could easily pop up. Besides being in a specific vertical, software company can have a huge moat by being ingrained in the company's culture, such as Salesforce. Salesforce is the backbone for its clients' relationships with their customers. So the chance that a company is going to change it over every year or every 5 years or even every 10 years is very unlikely. Instead, as the company grows, they'll keep buying more seats and using the software more, paying Salesforce more money. As investors, we also need to be aware of the payback period. The payback period refers to how long it's going to take for the SaaS company to recoup the marketing spend that it's spent to acquire the customer. If customers start to churn and the company doesn't slow down on its marketing spend, it's going to run out of cash pretty quickly. The biggest benefit of SaaS companies is that they have predictable revenue. Investors love this fact and in turn are willing to pay a lot of money for them. SaaS companies are typically valued on a PE ratio much higher than every other company. For instance, Bentley Systems trades right now at about a 69 PE, and Salesforce trades at about a 616 PE. So why are investors willing to pay for a company that makes no money? Well, there's two types of people that do that. The first type are just speculating, and they think that the stock may go up in the future, and they can unload it to somebody else later. Or if you're a long-term investor, you're waiting for the company to become profitable, so it could start to spew off a lot of free cash flow, and thus eventually pay a dividend. But that could take a while. Look at Salesforce, for example. That company's been around for over 2 decades now, and it's still kind of in the growth phase. Even though it's massive, it's still growing at a great pace, case, paying a dividend would interrupt its growth thesis. So in summary, if you're looking at investing in a SaaS company, there's a few metrics you need to pay attention to: ARR, churn, net revenue retention, and payback period. You also want to pay attention to the revenue cohorts to make sure those are growing. And I think it's probably a good idea to look at companies that are in a vertical niche, such as Bentley Engineering Systems, or that they have a wide moat by being ingrained in the company, such as Salesforce. And if you're looking for a dividend, you're going to be waiting a while. Even Salesforce, the most mature SaaS company out there, isn't paying a dividend yet. Thanks for watching. Be sure to like and comment.